Most of my money is invested in a single global passive equity fund, but I do buy active funds sometimes. So in this video, we'll look at what an active fund is, how they outperform, but also how to choose them and what to avoid, what the odds of success are if you do choose one, and also which active funds have outperformed over the last decade. And then I'll end with my favourite active fund and those of our PensionCraft community. This video is sponsored by Freetrade, the commission-free investment platform which is revolutionising the world of investing in the UK market. So let's begin with what we mean by an active fund. The idea here is that you're paying a fund manager to beat a given market. In other words, to generate a return which is higher than that market. And what do we mean by market? Well, usually that'll be something like a country. So if we buy a US equity fund, we'll be expecting it to beat a US index benchmark like the S&P 500. If we choose a UK stock fund, we might expect it to beat the FTSE All-Share Index, for example. So that market which we're trying to beat is often defined by an index, and sometimes that index is also called the benchmark. So the name of the game here is that we're paying high fees usually to beat that benchmark. And then a passive fund is a fund which simply tries to track that benchmark. It doesn't try to beat it, it just has to copy it. And that's much easier, and usually that comes with much lower fees. So how can a fund manager do this? How can they beat a benchmark? Well, if they are benchmarked against a certain index, they can just say, I think that this country is going to outperform the rest of them. This would be in the case of a global index, say. So then what they do is they buy more of that country's stocks than the index would suggest. In other words, they tilt towards that country. Or perhaps they think that a certain sector is going to outperform, for example, technology stocks or perhaps energy stocks. So the tilt in that case would be towards those sectors. Or perhaps it'll be a style of investing. Often fund managers come with a style. For example, Warren Buffett is famous for having a style tilted towards value. So he tends to buy stocks which are undervalued relative to some fundamental measure. Other managers may be tilted towards growth. For example, Cathie Wood's ARK funds are famous for having that tilt. Or perhaps it's quality. Terry Smith in the UK, for example, does have a quality tilt. And then finally, they might just have a very concentrated stock portfolio of stocks which they think will outperform. Some fund managers exclude the idea of an index altogether, and they simply try to generate the best possible returns. So not all funds are benchmarked. Now, if you are buying an active fund, what you don't want to do is buy an active fund which is simply hugging a benchmark, as it's called. What does that mean and how can we measure it? Well, there's something called active share. Think of that as the sum of the differences between the index and the fund manager's holdings. So if their holdings are very different from the index, then they have a big active share. They've taken a big bet, and if they're right, they can outperform by a large margin. Whereas if they only deviate very slightly from the weights of the benchmark, then their outperformance will always be limited if they play safe. But you might be justifiably thinking, why am I paying them to outperform when all they're doing is really just copying the benchmark? I could just buy a passive fund that could do that more cheaply. So what you should try and avoid is buying one of these index huggers, which is a passive fund in disguise. So to take some examples in the UK market, here I've got two active funds in the UK. One is the Barclays UK Alpha Fund. The other one's the Schroders Prime UK Equity Fund. And I've compared both of them with the FTSE All-Share Index, the total return version of that index. Notice how closely they track that over time. The Barclays Fund has underperformed, the Schroders Fund has outperformed slightly, but the fees on these funds are quite high. For example, the Barclays Fund has a fee of 1.1%. Now for that kind of fee, I'd expect exceptional performance. And yet that's not what we've had with this fund. Now some websites do actually give the active share of the fund, others don't, and you rely on the fund manager to score their own homework. But if you want to do this for yourself, just plot the returns in this way versus the benchmark for the fund and see how much it deviates over time. But I think there is a kind of recipe for success based on your behavior once you choose an active fund, assuming of course that that fund does itself outperform the market. And that's to choose a fund manager that you really believe in. Read what they say about how they build their fund, see what their investment thesis is, and see if you agree with it. Because if you don't, and you're just buying it because the performance has been good, then there's nothing to stop you chopping and changing in future if performance dwindles. And it always does dwindle at some point. So take a look at the historic return by all means, but that's not the be-all and end-all. It's really about buying a thesis, an investment philosophy, which you completely buy into, and a fund manager that you like. And then once you've found that fund, stick with it. Chopping and changing is likely to not work, and that's because you'll never know when the fund is about to outperform. Today's video is sponsored by Freetrade. Commission eating up your investments? Look no further than Freetrade for your solution. Invest commission free for over 6,200 UK, European and US stocks and ETFs. Today, Freetrade is also offering a free share worth between £10 and £100 exclusively for PensionCraft's audience. Ready to claim your free share? Head over to freetrade.io/PensionCraft today. You can also find the link in the description box below. Simply download the app, fund your account with at least £50 and get a free share. Looking for more? Freetrade also offers tax-efficient investing through a stocks and shares ISA and a self-invested personal pension. Prefer low-risk investments? They also offer you the only direct access to UK Treasury bills alongside an assortment of low-risk cash ETFs. With their Plus plan, you can earn 5% AER on up to £3,000 of uninvested cash while you decide where to invest. Perfect for all investment appetites. Never heard of Freetrade? They've been recognised as the best online trading platform at the British Bank Awards for 6 years in a row, as well as being recognised by Boring Money for share traders and low-cost ISAs more than 50k, to name a few of their accolades. Don't forget, visit freetrade.io/PensionCraft today to get your free share. And that brings us to the question of how often active managers outperform. And the index provider S&P Dow Jones Indices has a very large and extensive database of active managers to track which ones have beaten their respective index. And if we look at the year-end 2023 report and look over a 10-year period, and focus on just one fund subcategory, which is sterling-denominated global equity funds, the statistics are absolutely abysmal. 96% of those funds, global sterling-denominated active equity funds, failed to beat their benchmark. So you have a 1 in 25 chance of choosing the fund which is going to outperform. So this is why typically I don't buy active funds. I just don't believe the statistics show that fund managers can beat their benchmark consistently and with a high probability. But having said that, we can look at this small group of active funds which have performed best historically to see if we can eke out any patterns. So what I've done here is I've looked at active funds in the UK which are sterling denominated and looked at the return on those funds over the last decade. Now the fund which has come out on top here has a very strong return of 26% per year over that decade. That's the All-Spring Worldwide US All-Cap Growth Fund. Now I wouldn't read too much into the fact that that fund comes out at the top of the table, because if we read down that list of names at the top of the table, see if you can spot a pattern. So we've got Fidelity Global Technology, we've got JP Morgan US Technology, Legal & General, Global Technology, Polar Capital, Global Technology. You can see the pattern, right? Technology is where it's at and where it's been at over the last decade. In fact, there are 3 themes that dominate this table. Technology, the US, and then finally, the style of investing called growth. These are companies which are aggressively growing their profits year on year and thereby generating a high total return. Now I have put in a rogue fund here, I don't know if you've noticed, it's EQQQ. That's a sterling denominated NASDAQ 100 tracker. The NASDAQ 100 is a technology focused US index. So this passive fund has a fee of just 0.3% and yet it's beaten a lot of these incredibly well-performing active funds. So remember that if there is a particular style, sector, country, you can usually buy exposure to that same style, sector or country with a passive fund, and you can pay less fees to do so. So if you are going to buy an active fund, make sure it's something which adds extra, things which you can't normally buy. Unlisted stocks, for example, would not be available in an index fund, and some active funds offer these. Which brings me to my favourite active fund. And that fund is Scottish Mortgage Investment Trust. And this is something which I've held since it crashed after the tech wreck in 2022. Now, it was on my market crash shopping list. I just thought it was overvalued at the time, so I was waiting for it to plummet, and of course it did. Then it languished for a while, and then it started to pick up again. But the reason why I bought this fund as part of my fund portfolio, which is just a small percentage of my overall investments, was because I just like its investment thesis. It publishes regular reports on what it's buying and why, and I just like the ideas behind it. It tries to identify global themes based on changes in human behaviour, and then it identifies which companies are most likely to lead that charge and be the most successful in that space. For example, it buys SpaceX, which is an unlisted stock, and that's in its theme called New Space. In fact, it's bought a lot of companies before they were listed on the stock exchange, companies like Spotify, for example, but also Alibaba. And then if the companies are successful and they list on the stock exchange, then Scottish Mortgage banks a very good return. So I love reading their annual report about which companies are best and the kind of nerdy themes which go with the fund. Yes, I'm a Trekkie. So I'm going to hold this fund for a long period of time, simply because I like the managers and I like the investment thesis, and I also like the price I bought it at. But I haven't gone all in on it, I've just got a small percentage of my total investments in case it goes wrong. Now, I asked our premium members on our PensionCraft chat forum which active funds they liked best, and I got lots of answers. And surprisingly, one of the funds that came up the most was a money market fund called CSH2. This is the Lixor Smart Overnight Return Fund, and it's an ETF, it's listed in the UK, it's sterling denominated, and it's returned about 5.2% recently because that's the sterling overnight index rate. So because the Bank of England's trying to combat inflation by raising short-term interest rates, the return on this fund will track roughly that policy rate. And its volatility is very low, it's an accumulation fund, its price just steadily increases with almost no volatility at all. So as a safe investment, a lot of our pension crafters liked it. There were some really funny comments as well. For example, one person said anything that doesn't start with the letters SJP, St James's Place. Clearly they got burnt by SJP. Other people said interesting things. For example, one person said they buy CSH2, an ultra-safe fund, combined with Scottish Mortgage for the wild ride. Combining those two produces something kind of sane, but it's an interesting juxtaposition of two different funds. So here's the list of the funds which they named. Notice that the expense ratios are pretty high here in some cases. One fund is as high as 1.7%. That's the HG Capital Investment Trust. But bear in mind also that these pension crafters are like me. They'll have a globally diversified index fund, and this stuff is just a bit of fun to add juice potentially if it does outperform. So in conclusion then, I think what's really important is that once you choose a fund that you like, make sure you understand it, but then once you've chosen it, stick with it, because chopping and changing is unlikely to work. Eventually, all funds underperform, and that's why a lot of active funds say, don't hold this for less than 5 years. That really gives them a chance to actually outperform. Another point is that you don't have to go all in with these active funds. We saw the statistics are very much against active managers outperforming. Consequently, I would not bet the farm on that happening. If you are going to be investing in active funds, I'd make it a small proportion of your overall investments. And one of the reasons for that underperformance is that it's net of fees. If the fees are very high, effectively the manager's creating a very high bar, which they have to beat every year to outperform. So it's not an accident that the funds with the smallest fees usually are the ones which tend to do best. And don't forget our offer from Freetrade to claim your free share worth between £10 and £100. Terms and conditions apply. Just head over to freetrade.io/PensionCraft, and that link will also be in the description below. And as always, thank you for listening.